Whether you're a seasoned investor or new to the game, you must have heard the age-old saying that once-in-a-lifetime financial opportunity is on the rise. While we admit that it's often a bit of a stretch, make no mistake, a radical change is genuinely happening in the economic world right now, and it will bring forth many opportunities. And in fact, even some of the best minds in economics and finance agree with this. They know a big chance has arrived. If you're familiar with Howard Marks, you should know he's a pretty big hotshot. With a net worth of over $2 billion, he is the co-founder and co-chairman of Oak Tree Capital Management, the largest investor in distressed securities worldwide. In a recent interview with David Rubenstein on Bloomberg Wealth, he discussed a lot of interesting topics and economic trends. But we couldn't help raising our eyebrows after he said this.
We never know where we're going, but we sure as hell ought to know where we are. We're no longer in an easy money environment. If it's the change I think it is, then what you should have in your portfolio going forward can be very different from what it has been.
Now, before you get frightened, let's properly dissect the change he is referring to. Dubbed a sea change in economics, this describes a total change from the status quo in the financial world. That said, are you curious about the significance of this change? After all, something new unfolds in the financial markets every year. Keep your eyes wide open for this.
The Fed took the Fed funds rate to zero to fight the global financial crisis, left it there a long time, and didn't have any luck getting it back up into what you might think are normal ranges. So we had a low interest rate environment which made life very easy for borrowers, asset owners. It was easy to run a business. The economy did well. We had the longest bull market in history, the longest economic recovery in history.
Did you know that financial markets tend to follow similar trends? As a matter of fact, over the past 4 decades, financial markets have been characterized by only 2 contrasting phases of interest rates. While the first period covered a 30-year span of consistently decreasing interest rates, the second period that followed marked a decade where interest rates remained at rock bottom. This had substantial implications for asset prices, including stocks. Take the S&P 500, for example. Did you know that it increased from about 100 points in 1980 to 4,200 points today? This means that if you invested only $1 in the U.S. stock market back in 1980, your investment would be worth more than $40 today. But here lies the burning question. What exactly drove the S&P 500 to explode so much? The answer is surprisingly simple. The substantial increase was born from the profits of companies within the index. Here's something that will blow your mind. In 1980, the earnings per share of the S&P 500 were around $15. Today, they stand at approximately $175. Just soak that in for a minute, guys. That's a whole 12-fold increase. As the companies in the index kept making higher profits, the stock market ascended as well. That said, let's not forget the interest rates. As they decreased, the returns available on fixed income securities, including government bonds, also diminished. This shift compelled more investors to turn to the stock market, leading to a willingness to pay higher prices for stocks than in previous periods. In the 1980s, the price-to-earnings ratio of the S&P 500 was about 7, signifying that investors were willing to pay 7 times more for the S&P 500 than profits these companies generated. Fast forward to today, and this ratio has surged to 23, primarily due to the decline of interest rates. This shift also played a significant role in the growth of the stock market over the years. Moving on, have you ever wondered how these low rates affect companies? Here's an interesting analogy from Howard Marks.
You know, there is a part in Sea Change where I talk about the fact that a guy says, oh, we can buy this company and make 10% a year. And then he turns to his capital markets person and says, what will it cost to get the money? We can borrow at 8. Borrow at 8, invest at 10, great, we do it. You buy the company, but in the stimulated environment of low interest rates, the company does better, you make more than 10. Your cost of money declines from 8 to 6 to 5, and it costs you less to borrow the money, and you say, boy, I'm a genius.
The thing about low borrowing costs is that it puts more money into the hands of consumers, which gives businesses more profits in return. Plus, it also makes the expansion of the businesses cheaper. However, that's now a thing of the past. The prospect of another 30-year period of declining interest rates is highly unlikely, given that the initial decline was facilitated by exceptionally high rates in the 1970s. This leaves us with a couple of potential scenarios. One is a return to rock bottom, easy money environment, though that does seem improbable. The more plausible alternatives are moderately high interest rates, or even a sustained period of increases in interest rates, contrasting the trend observed over the past 4 decades. Alas, in either scenario, businesses would face greater challenges, making it harder for corporate profits to increase. Consequently, stock market investors might not witness the trend of stocks continuously becoming more expensive. If the price-to-earnings ratio of the S&P 500 contracts, even if corporate profits were to rise by a factor of 12 over the next 40 years, as they did in the previous 4 decades, the stock market might only experience a 6-fold increase, significantly less than that 40 times observed in recent decades. The days when interest rates were at rock bottom, they're long gone. As a matter of fact, they're now at a very high point. That said, in case you're wondering why it hasn't negatively impacted businesses in our economy yet, take a look at this.
So most bankruptcies don't occur because you have a business and it loses money, goes away. It occurs because a business borrows money, times get tough, and when it goes to refinance that loan, nobody ever repays their debts. They just refinance it. And when they go to the bank to refinance it, the bank says, you're not as good a credit as you used to be, or we don't have as much money to lend as we used to have, or our standards are higher.
The majority of bankruptcies or defaults arise from unmet maturities. When transitioning from a period of easy access to funds for any or no purpose to a phase where obtaining funding, even for valid reasons, becomes challenging, it becomes evident that a greater number of companies will encounter difficulties. Contrary to widespread belief, bankruptcies aren't entirely byproducts of a business not being profitable. It's way more complex than that. Bankruptcies happen when a firm that is not generating profits is unable to raise enough capital to cover its barren spell of losses. After all, who in their right mind will confidently lend money to a business that consistently ends its financial year with heavy deficits? Well, you'd be surprised to know how often this happens. Over the past decade, a lot of people have been willing to loan out money at cheap rates to these zombie businesses that were basically burning cash and generating meager profits. And guess what? Those businesses kept surviving because they could easily borrow more money to pay off their old debts. According to the most recent data, approximately 10% of publicly listed companies are in fact classified as zombies, although this situation may be changing soon enough. While these companies previously managed to effortlessly refinance and roll over their debt into new, inexpensive debt, the current higher interest rate environment, it presents challenges. Refinancing at a higher interest rate or encountering difficulties in securing new loans from banks may become a reality for these companies, and here's why. Similar to households, companies have the option to borrow money at fixed rates, often with maturities extending 5, 10, or even more years into the future. Consequently, the effects of rate increases on businesses are not immediately apparent, or may take several years to fully materialize. But that's where the make-or-break opportunity arises. People who have only begun investing since 1980 and have only seen declining interest rates, or ultra-low ones, they can be severely short-sighted. Instead of recognizing the sea change, they'll be too engrossed in the past. If Howard Mark and a lot of economic experts who support this notion are right, then you should be switching your portfolio strategies. Going forward, your portfolio might be very different from what it has been. Let's take a step back to briefly refresh our memories on Investment 101. When it comes to investing, there are 2 ways to do it. You can either be passive about it or active. Active investors are individuals or entities that actively manage their investment portfolios, making frequent decisions to buy, sell, or adjust their holdings based on market conditions, research, or analysis. They typically aim to outperform the market and generate higher returns. But on the other hand, passive investors take a more hands-off approach, often tracking a market index or using other investment strategies that require minimal ongoing adjustments. Instead of constant buying and selling, passive investors seek to replicate the performance of a specific market or asset class, accepting returns in line with the overall market. The key difference between active and passive investors lies in their investment approach. While active investors actively make decisions to beat the market, passive ones adopt a more passive, long-term strategy. These aim to match the performance of the market. To properly adjust to the change, you've got to know the category that you fall under first. Once that is done, go back to the drawing board. For passive investors who consistently invest in, for instance, an S&P 500 index without frequent adjustments, you don't necessarily need to make any significant changes to your strategy. Despite potential variations in future stock returns compared to historical performance, as long as the American economy continues to grow, the stock market is expected to follow suit, and passive investors should have no problem at all. However, a broader range of options is now available for individuals actively allocating capital. The S&P has consistently delivered an annual return of slightly over 10% for the past 100 years, resulting in significant growth. This rate of return, turning $1 in 1920 into $15,000, highlights a favorable investment performance. Nowadays, credit instruments, commonly referred to as corporate bonds, provide the potential for equity-type returns with significantly higher interest rates. And get this, according to Howard Marks, certain corporate bonds can yield returns comparable to stocks while presenting a lower level of risk. However, if you choose to explore these investments, possessing the expertise to analyze them is crucial for confident investing. The key takeaway is that elevated interest rates result in increased yields across various investments, eliminating the need for a substantial allocation to the stock market to achieve a respectable return. That being said, there are a couple of mistakes you should be careful about. And number one is, don't overestimate yourself. Guys, you cannot predict the future. No one can. When you take a look at what macroeconomics has been like in recent years, you'll see how crazy and unpredictable it can be. Even the Federal Reserve gets it wrong from time to time. On several occasions, they've incorrectly forecasted inflation despite having access to the best and most recent data. Take lots of care, guys. If your investment strategy hinges on you knowing what or how interest rates will be in the future and how inflation will affect things, well, you've got to tweak it. Additionally, never forget the fact that investing is more than just a quantitative game. If it were otherwise, stock prices would promptly incorporate all available information, resulting in minimal market inefficiencies. In such a scenario, retail investors would have little chance of outperforming professional investors. However, the market that we have all grown to love and study is significantly influenced by human psychology. In order to own the market and make yourself financially successful from it, you need to have a comprehensive understanding of all the elements at play. Don't stop just there. Relearn, unlearn, and keep practicing. Still in doubt that quantitative understanding is not enough? Let's look at things from this perspective. Do you know that thousands of researchers and hedge fund managers study companies? They work around the clock to find undervalued companies. So, with that in mind, how on earth do you think that you'll be able to find some kind of quantitatively undervalued company in the market that thousands of more experienced people all missed? You'll need a tree made up of 4-leaf clovers to be that lucky. The most effective and practical approach to outperforming them is to capitalize on their vulnerabilities, specifically the pressure on quarterly and yearly results and their inclination to minimize volatility. One of our favorite parts of the Bloomberg Wealth interview with Howard Marks is the part where he gave us pretty neat investment advice, completely free of charge. Before we unpack it, however, here's what was stated right from the horse's mouth.
And say, well, you're a famous investor, I've got $100,000, what should I do with it? Or what do you tell people about what they should do with their money when they just ask you for free advice?
Well, the main thing I do is I say that's kind of like going to a doctor and saying, do you have any good medicines? What is the condition you're trying to treat? Do you have more money than you need or less? Are you going to live a long time or a short time? Do you have dependents? What are their needs? Do you have what it takes viscerally to live with ups and downs? Or not? If it's going to make you miserable, you shouldn't do it.
Basically, what this means is that investments work best when they are tailored to the needs, the wants, and the goals of the investor. Copying investment strategies is like giving you a well-crafted route to head west when you should be going north. Just as no two individuals have identical life paths, financial trajectories differ significantly. By aligning investments with personal circumstances, you'll be able to gracefully navigate the complex landscape of financial markets. Tailor-made investments consider factors such as risk tolerance, time horizon, and financial aspirations. This personalized approach not only mitigates unnecessary exposure to market volatility, but also enhances the likelihood of meeting specific financial objectives. It's like having a bespoke suit, the best fit that complements and accentuates individual strengths and preferences. And let's not forget the fact that customized investments instill a sense of confidence and emotional comfort. When financial strategies resonate with personal values and goals, investors are more likely to stay committed during market fluctuations, especially when there's a long-term goal. Don't blindly follow some of your favorite investors whenever they make a move. Instead, learn from them and put everything into perspective. If it feels right, only then should you follow. Always remember that not every good prospect needs to be in your portfolio.